Way of the Turtle Curtis Faith. In 1983, a Chicago commodities trader made a bet that would settle one of the oldest arguments in the business: whether great traders are born or made. Richard Dennis was certain they could be made, so he ran a real experiment with real money to prove it, and Way of the Turtle is the inside account of what that experiment actually revealed. Core thesis. Dennis recruited ordinary people from a newspaper advertisement, trained them for 2 weeks, funded them with real accounts, and set them loose with strict instructions to follow the rules he had taught. The group became known as the Turtles, and Curtis Faith was the youngest of them, and by a wide margin the most profitable, earning over $30 million for Dennis while still in his early 20s. The experiment settled the bet. Trading can be taught, but the detail everyone misses is what Faith spends the book explaining. Every turtle got the same rules, the same training, and the same kind of account, and yet some made fortunes while others washed out. The system was identical, so the difference could not be the system. The difference was almost entirely psychological, the ability to keep executing the same simple rules while emotions screamed to do otherwise. Faith's verdict is that trading success is roughly 70% psychology and 30% method. Most traders spend their lives searching for a better system, when the actual problem is that they cannot follow the one they already have. Systems, he says, are commodities. Execution is the scarce skill. What a complete system looks like. The turtle system itself was almost embarrassingly simple. Buy when price broke above its recent range, sell when it broke below, ride the trend while it lasted, and get out on a defined signal. There were no secret indicators, no predictions, and no opinions. The genius was not in the entries, because in the completeness, because a real system answers every question in advance. What to trade, how much to risk, when to enter, where the stop lies, and how to exit, all decided before the money is ever at risk. The most important piece was the sizing. Every position was scaled to the volatility of the market being traded, so that one normal day's adverse swing risked the same small slice of the account, whether the instrument was quiet or wild. A volatile market got a small position, a calm one got a larger position, and every trade carried the same weight of risk. Combined with a hard stop set by the same volatility measure, the sizing meant no single trade, and no normal string of losses, could ever end the story. Why simple rules beat clever humans? Faith grounds the whole approach in the behavioral research of Kahneman and Tversky. Human cognition is reliably biased. People hold losers too long because losses hurt more than gains please. They snatch profits early to lock in the feeling of being right. They see only the evidence that agrees with their position, overweight whatever happened most recently, and hurt into the same trades at the same moments. Those biases are not just personal weaknesses, they are the reason trends exist. When new information arrives, the crowd adjusts slowly and reluctantly, and price grinds in one direction for far longer than a rational market would allow. A mechanical rule that simply buys the breakout captures that drift precisely because it does not share the hesitation. The edge of a systematic trader is not brilliance. It is the absence of the predictable human errors, and the moment a trader starts overriding the system by feel, the errors climb back aboard, and the edge quietly leaves. What an edge really is. Faith is ruthless about the word edge. An edge is not an indicator, a secret, or a hot streak. It is a statistical advantage, a setup that over hundreds of repetitions pays out more than it costs after every friction. The advantage is usually small, the variance around it is enormous, and short runs prove nothing in either direction. A setup that has just won 6 times in a row may have no edge at all, and a genuine edge will still hand you ugly losing streaks on schedule. This is where Osiris Capital Trading Desk takes the turtle lesson personally. It grounds its coaching in evidence rather than conviction, refuses to quote a statistic it cannot source at that moment, and treats back-tested results as research to be respected rather than promises to be spent. An edge, in its world, is something demonstrated across a sample, never something remembered from a good week. Falling off the edge. The most valuable chapter explains the pattern that kills more competent traders than any other. A trader adopts a sound system and trades it well while it wins. Then the normal drawdown arrives, exactly as the long test always said it would, and the trader decides the system is broken. They add a filter, skip a signal, tweak a parameter, and the signal they skip turns out to be the big winner that would have paid for the entire losing stretch. The system was never broken. The trader broke first and broke it with them. Faith's defense is pre-commitment. Write the rules down before trading them. Test them across years of history, including the worst stretches, and look hard at the deepest drawdown the test produced. If you cannot live with a drawdown of that size, the answer is a smaller position, never a midstream rewrite. Then commit to a full sample of trades before the rules may be judged. When the losing stretch tempts you to start rewriting, Ozara's desk holds the record up in front of you. The discipline cycle you committed to, the count of clean trades so far, and the logged cost of every past deviation are all on the table, so the system gets its full sample before it gets sentenced. The maths of survival. Faith insists that position sizing matters more than entries, and the argument is pure arithmetic. A brilliant signal traded 2 large dies in its first serious drawdown, while a mediocre signal traded at sensible size survives to compound. Size determines survival, and survival determines everything else, because the trader who is still standing gets to benefit from every future opportunity and every future improvement in skill. The quiet corollary is that proper sizing caps how much any one trade can swing the account. Risking a small fixed slice per trade means even a spectacular winner only moves the account a few percent, and that is the point. The turtles grew fortunes through dozens of modest trades compounding across years, not through hero swings. Getting rich quickly and getting rich reliably are competing goals, and the professionals chose reliably. Thinking like a game player. Faith frames gritting as a handful of mental stances, borrowed from games of chance played well. Stay in the present moment, because the last trade and the next 100 are none of this trade's business. Judge decisions by their probabilities, because a good bet that lost is still a good bet. Grade yourself on process, because process is the only thing you control. Treat uncertainty as the water you swim in rather than an enemy to be eliminated. And keep the long view even inside a 5-minute chart, because the year is decided by the full distribution by today. Each stance disarms one of the biases from earlier chapters, and together they describe the psychological profile the experiment was really selecting for. The best turtles were not the cleverest. They were the ones who could hold these stances while real money moved against them. The discipline of doing nothing. One more turtle trait separated the winners, and it looks like laziness from the outside. The best turtles could sit through long stretches of no signals without inventing trades to fill the silence. The strugglers either manufactured setups out of boredom or hesitated when the genuine signal finally arrived, having spent their nerve on trades that never deserved it. Faith treats emotional energy as a finite resource. Every marginal, boredom-driven trade spends focus and composure that the year's few great trades will need. The professional's silent skill is conservation, watching without acting, so that when the real opportunity comes they meet it fresh and decisive. Ozara's desk does this filtering with you. Weak signals are rejected quietly rather than narrated, so the marginal setups never even reach your attention. And your energy is saved for the trades that actually carry an edge. Honest tests and dishonest ones. The book closes its technical case with a warning about backtests. It is alarmingly easy to torture historical data until it confesses, tuning parameters until the past looks perfect, and then discovering that the future disagrees. Survivorship look-ahead errors and ignored costs all inflate the same illusion. Faith's rules of hygiene are blunt. Choose parameters once, test on data the tuning never touched, model costs pessimistically, and then assume live results will still come in meaningfully below the test. A system needs strong results with a safety margin, because some of every backtest is a mirage. Bottom line, Way of the Turtle is the cleanest evidence ever produced for trading's most uncomfortable truth. The system was never the bottleneck. A group of beginners, handed identical rules, produced wildly different results, and the difference was the discipline to execute without interference. Faith credits his own success to two traits anyone can build: distance from his ego, so losses were data rather than insults, and loyalty to the system, so drawdowns were weather rather than verdicts. Stop searching for the perfect method. Start becoming the person who can run in the perfect one properly. Trading forgives very little, and a rule like this only earns its keep once it survives contact with real risk. Ozara's desk is built for exactly that of contact, an advanced platform for trader development and disciplined trade management, and the flagship of Osiris Capital. So the craft does not stop at reading, because Osiris desk treats this very book as method, not memory. It treats an edge as evidence rather than a feeling. It holds you to your rules through the drawdowns that test them, and saves your attention for the signals that earn it, until executing like the best of the turtles is simply how you trade.